They want to
money.
give you money. To be honest, like the lenders want to give you money. They want to help you build a portfolio, but you've got to be that strong package, right? Like,
All right, thanks, guys. Welcome back to Opta Financial, and I'm Freddie Rappina, and this is Chess versus Checkers podcast. And our guest today is Kevin Suba, who is a loan person, the best person
money
to
guy.
know in the world, the person with other people's money, as we talked about many times, the type of person that it's my job to make you look really good for him because he has other people's money. So we'll just jump right into it. Kevin, how'd you get into the businesses?
Yeah, man. Hey, thanks for having me. First of all, so do you mind if I share a little bit of my career story?
No,
I
go
guess?
ahead, man.
So basically, played college baseball and wasn't quite ready to grow up when it was all done, and I got hurt. So it's not like I had the opportunity to play pro ball or anything like that. But went to the military, wasn't quite ready to hit the corporate world. Did the intel thing, government sector for almost 10 years between the Army and private sector government stuff. And then went to the corporate world, climbed the ladder. And all that time, it was more just getting myself like, where can I go with my career? Like, I wanted to climb the ladder. I loved money. I wanted to make a ton of it. I wanted to build wealth, but I didn't know how to do it. Like, nobody taught me how to do it. I didn't necessarily, I didn't have a coach, if you will, right? As an athlete, I needed a coach that would help me get there, and I wasn't interested in reading the books like I probably should have. But fast forward, I just had some stuff happen that drove me to the corporate space. I had some friends in the lending world, and I saw how well they were doing, and they were just crushing it. And I was just like, man, they're like making tons of money and really doing well in that. And of course, it was the refi boom, right?
Right.
And from there, I was like, you know what? I'm gonna do it. I'm gonna go out on my own. And the bigger picture for me was business ownership and have a pathway to that. And I'm still working for somebody right now. It's a small business with Royal and Company Mortgage. We're a small boutique lender in Brandon, Florida. And I started talking and having conversations with her a couple years ago, and I decided like, hey, I'm getting the license. I'm going to go work for her. And essentially it's like running my own business. Even though I am technically an employee, I'm kind of partnered with her, and we're growing a business and doing mortgages.
Can you tell me the difference between, of course, I already know the answers to this,
Yeah,
but the different types of loan people, as I joked about.
Yeah,
It's
for
like
sure.
there's the broker loan, originator loan.
Yeah. So my license,
Oh,
I'm
mortgage
technically,
guys.
my licensure is a mortgage loan originator. So that's like our technical term, right?
Mm-hmm.
Most people know us as loan officers. Excuse me. And you have brokers, which is what I am. So mortgage broker, I'll explain just a second. You have correspondent and retail. Retails are your big banks, right? The ones that you would go to. Correspondents are going to be more of like the mid-size. They're kind of using their own money. They're getting lines of credit, and they're getting funds out there, and they've got some of their own rate sheets, and they kind of have their own guidelines and dictate what they do. And then the mortgage broker is basically we're personal mortgage shoppers. We shop for you. We connect the consumer with the money. So whether that's a residential purchase, whether that's an investor purchase, we do home equity line of credits too. We do HE loans, we do HELOCs, fixed rate mortgages, conventional, all your QM stuff. The beauty of being a broker is that I can go find a product. So if there's a lender out there, a wholesale person out there, I can go find it.
So it's different lenders.
Yeah.
Different
So
people.
yep,
It's
for
not
sure.
just one that you got to
Nope.
like. If
I'm
that
not
person says
bound.
no,
That's
then
right.
you're just
Yeah,
stuck.
I'm not bound to one lender.
Gotcha.
So great
Right.
question, Freddie. Like I have underwriters at each of the lenders that I use, and based on some of them have overlays and guidelines that they would say as a criteria. Maybe that one didn't get through for one reason. Well, if I know I got another lender that can do that, I can switch and go to a different lender.
Because it even took me some time to figure out the differences between all of that,
sure.
because it all kind of sounds the same, right?
Right.
To your average consumer, where there are some significant differences once
For
you like
sure.
drill down a little bit. So, but no, I'm glad. Thanks for.
Yeah, and I'm not the expert on what the other ones do. I know more about what the brokers do because that's the model that I have under me.
Right.
But from my understanding and knowledge of the others, is that's their underwriters and their guidelines that they have set in place. Of course, Fannie Freddie, when it comes to the conforming stuff and the guidelines placed out there, that's what they typically stick with.
Mm-hmm.
The beauty of it being a broker is that like we can go find different lenders, and some of those lenders add requirements on top of it. Let's call it that, or rules.
Nothing sucks more than the underwriting process when when you're like, I don't know, 60% of the way through, and then all of a sudden you get all this big dump of things you got to do, and you're trying to find this papers in the file cabinet, and you're like, where? But let's talk about like just mortgages in general, right? Sure. Okay, so we're talking about building wealth, right? And there's this idea out there now that I'm hearing occasionally that you shouldn't own a home at all, just rent. And and there's in my opinion, is a school of thought, right? So if you're going to be a renter, all right, you're in a high cost of living area, right, where it's just super expensive to own a home. Not owning a home in that area, in my opinion, may be the right decision, right? But just not owning real estate is likely not going to be a solution, right? So if you're in an area that has a very high cost of living, maybe rent, but purchase real estate in lower cost of living areas where you're going to develop cash flow that's going to eventually, if you do it enough times and do it correctly, cover the rent that you have to shell out in your high cost of living area. Now it's at least washed, and you're still building equity in the homes that are out there, wherever they are, for sure. Instead of in the home that you're actually sleeping in at night. So, any thoughts on that? Like I don't think it has to be an either or.
I think, I think of my own self like 20 years ago. If you would have said cash flow to me at 18 to 25 years old, I probably would have been like, what's that mean? I don't whatever. So I think it becomes like, when I talk about this all the time with buyers, right, where sometimes renting does make sense. A couple of thoughts here is like, if you're not financially ready to do it or you can't afford it, let's set a plan and let's look at the bigger picture of it. I think the person has to have the stomach to risk that, if you will, of, if I don't have a piece of property to begin with, am I going to be able to go buy that property somewhere else and have that mindset to do it? I love the strategy. I think it's a great strategy. And I think people like us can educate and say, this makes a lot of sense to say, okay, you got to rent here, because like Tampa alone, Tampa's, I think, at least $2,000 a month in average rent for just a 1 or 2 bedroom apartment.
Oh, and some people like us right now in like San Francisco are laughing at your $2,000 figure there.
Major costs out that way, right? So you go, on average, that's about the number I see for a rent cost when I get renters or first-time home buyers coming my way. And I agree with you. Like, even like, honestly, one of the things I probably would look back at is like, get a friend, buy a house with a friend. Even, I mean, it's riskier, but it's the idea that I'm not dumping money into another investor's pockets. I'm going to be the investor myself. But I love your idea of like, hey, what if I want to buy a duplex up in like wherever, Smallville, USA, and it's got cash flow and it's making me a couple $100 a month. There's some books out there I'm thinking of that, like, I don't know if I could cite a Robert Kiyosaki phrase, but like basically talked about his first piece of debt made him $25 a month in cash flow, and he was thrilled. Debt made him money, and I'm like, holy crap! If only I would have thought of that when I was young. So, I love your thoughts on that.
Almost every podcast I say, I'm like one of the few financial advisors that I know that will say this out loud. I love debt.
Yeah.
Love debt.
me too.
The right kind of debt, though, not running up your credit card at Walmart or anything like that, but 100%. Understanding how debt can help create wealth.
It's a tool.
Yes.
If you leverage it the right way, like, great point. And as a mortgage guy, the last thing I want to see is 15 credit cards on a credit report, right? And it happens. Like, you got, I think the worst I've seen is probably 17, and most of them maxed out. They made lots of money, but they are all maxed out, high interest rates.
Yeah, it's not good.
And it's just not good. A mortgage, that's a tool. That's a good debt, using that. Yeah.
So, and if you're going to do the typical thing, which is buy a house where you live, there's nothing, I don't see that that's wrong either.
Yeah.
Right. It's when people just can't afford that home where they want to live.
Yep.
Because even around here, man, things went up like crazy over the past few years.
Definitely.
All those Northerners just keep moving down here and
Yeah.
it's driving up the real estate market. Don't you just want to reach across this table and just punch them in the face?
I mean, I know you're one of them. I probably would be considered one too because I moved down here in 2009. But it's true. I mean, like you think about there's a lot of people. Maybe this isn't your place, right? Because Florida, it's a wonderful place. I love where I live, but I'm fortunate. I moved here a long time ago, and maybe that's a target goal down the road. Maybe you have to readjust and set a strategy on how you're going to do it. Maybe it's using that cash flow somewhere else to get billed on properties. So I'm renting in Tampa. I'm building cash flow somewhere else to boost my income. You can qualify with that. You're going to buy that house that you actually can afford. So.
Right. And so you don't have to go into super duper debt with that massive loan where you live, where now you're like a slave to the bank.
That's right.
Right. You still keep your mobility because, every year if your lease is up, you can just kind of pack your stuff and go somewhere else.
Right.
And still having the mindset of like, I'm still a homeowner. I'm still building wealth. I'm still doing these things. I think that's just missed on a lot of people. There's different schools of thought there, but
for sure.
I just don't want people having the paralysis by analysis.
Yeah, it's the only way isn't to say I've got to buy this primary residence where I live is a way to own a house. Like you're right. There's other ways I can do it through investments. And, you got to put a little more money down. An investment property right now in this market, on average, 20 to 25% down is what we're having to see, people put down. Like if I'm a first-time buyer in a primary residence, I could probably get as low as 3%. There's some lenders out there doing as low as 1%, like a down payment assistance type program. There's options for primary residents and first-time home buyers, but even there's still high cost and there's still, there's payments, right? There's higher purchase price on a single family. I mean, I think like what I bought 10 years ago versus the price today, like it's a big difference, right? The first-time home buyers on average are $250 to $350 probably right now in Tampa alone.
Really?
So yeah, for a starter home, I've seen on average $250 to $350.
Yeah, and that's what we're seeing go away, right? We're seeing the starter home not being an option for a lot of people, which is, in my opinion, really, really
sad.
Puts a hurt on.
Yeah,
puts a hurt on a lot of people.
I agree.
But it's the starter home you don't want the starter home also be the forever home.
No
either.
doubt.
So I don't want to see people become slaves to the bank.
Yeah,
I want them to be partners with the bank.
Yep.
Right. And building wealth, saving money, investing.
They want to give you money. To be honest, like the lenders want to give you money. They want to help you build a portfolio, but you've got to be that strong package, right? Like we talk about the credit cards, a bank is going to help you. They're there for you, whether it's a mortgage person that does just mortgages, whether it's a banker. I'm friends with some of them, right? I know some of these bankers. They want to help you. They want you to keep their money with you. Like they want to give you loans. They want to do the right deals for you.
Well, that's how a bank makes money.
That's right. Totally.
It says it on the wall when you walk in.
Right.
They're going to pay this much in interest, and then they're going to charge this much.
And you said it a little bit ago at the start. You basically said your job is to make them attractive for the money people.
Right.
Like for you to go get money, like assets, right? Assets is valuable. Your business is give me your portfolio of investments, if you are, your 401ks, your retirements, all that kind of stuff. That's going to help you make a stronger case for you. If you have great credit, you show assets, retirement stuff, that's just going to help you with the lenders, whether it's a mortgage broker, a correspondent, a banker. If it's your personal regional bank and you walk in there and you can show all that portfolio, you're going to get approved for a loan and be able to do creative stuff.
So let's say what's out there for people that want to purchase property and maybe they don't have a ton of reserves. Maybe they have some reserves, but they don't have a ton. Like, what other types of things that they can do?
So we're talking like a home buyer or an investor?
Investor.
So an investor, I think that's always a challenge, right? Is the capital. So if they have properties, you can use. Well, let's talk about a DSCR loan, debt service coverage ratio loans. You have conventional stuff to be able to just do your purchase with both of those. But there's also a cash out refinance that allows you to pull that equity out of the property. So whether it's a conventional or a DSCR loan, the DSCR, real quick to just cover that, it's taking the rental income divided by your principal, interest, taxes, and insurance. And it's a ratio, right? And based on that ratio is how you would qualify for that mortgage. And then your capital, So like in the case of if I've got a cash out to help me buy another property, reserves are much more limited. And I don't know the guideline off the top of my head. It's just a couple months, just to show. And you can use 401ks or retirement accounts, something that's potentially liquidable. And again, guidelines, I don't know them all off the top of my head, so just wavering.
Right,
I might not be perfect on all the guidelines. But in any event, the DSCR cash out refinance, if you have a property that you've owned for a while, can help you get that cash out to go buy that other investment property.
Okay, so from understanding you right, the property is what's qualifying for the loan with this DSCR loan.
If I have a property that generates income,
right.
rental income, right, on the DSCR,
and it's clear. It's proving to it's not it's going to produce.
So
income.
as long as that property is going to produce income, like there's a couple of things there. If we're going to build something, there's options for that too. That's a little bit of a different conversation. But if it's an existing structure that it's going to produce income or revenue, I take that revenue divided by my payment, essentially my all-in payment, and then whatever that ratio is, it can help me qualify. I have a lender that I work with that will go as far as 0 on the cash flow.
Whoa.
Well, you're going to pay for it somewhere, right? Whether it's in the rates or the down payment, you're going to pay for it somewhere. But it's the idea that there's lenders out there that will do some creative things to help you gain that asset. Now, if it's more income, the better, because that's going to help you qualify for better terms, right? And help you get that better. But it's the idea that I don't have to bring my business into it, my tax returns, I do bring my personal credit report in.
Right.
I do show my assets, like what's whatever that account might be. Maybe it's just one account that's got all your assets in. You show that one statement, you could use that.
So all that paperwork, pain in the butt that I spoke about earlier doesn't exist with this.
Next to none. Yeah. That's the beauty of it. Conventional, different story, right? If I go conventional, I can. And the other thing I should mention, the DSCR, I can buy under a business. So I can actually use a business, or you could use an LLC, S corp, corporations. I can't remember all the different entities you could buy with, but I don't necessarily have to bring in my personal name.
Right.
And so it's not, think about the counties. They can pull your records and see what you got. You don't have to worry about that with the DSCR because you can put it under the business name. So then you would show, you may have to show a business document, like here's my P&L. You have a bank statement showing here's my funds for my down payment if I'm doing it that way. If it's a cash out, you wouldn't have there's not a bank statement involved there because you're pulling equity out of the property.
Having funds that's what you like more than anything else, right?
Of course. Yeah.
Having money to pay back.
That's right.
If you wanted to, having the money to pay back the loan is what Kevin and the like are going to want to see. That doesn't mean you want to pay back the loan with this money.
I don't want you to be honest. I don't want you to pay the loan off. I want you to keep it.
He wants interest, right?
Yeah, we want you to keep the loan.
He wants to keep the loan. So having the money to pay it back, though, at any point in time, I ask this question all the time to people: is it really debt now? If you had the money to pay it back, but you don't want to, you're just going to take out a loan against it.
Right?
Is it really debt? Because at any point in time, you can just sell the portfolio and pay back the loan. But it's just a tool, and now I just hope it doesn't get abused and people start doing crazy stuff. And
I agree.
It's throwing people into houses that they can't really afford and all that kind of stuff. But it's an option available for people that have the money down, maybe not have the ocean behind them just yet, but they're looking to purchase a property. But let's talk about a little more about conventional stuff. Everybody wants to talk about the rates right now. It's like 7.1, 7.2 right now at the time of this recording.
Yeah, we're seeing rates in the 7s. And I think 8s are coming.
Yeah.
Right? This is Kevin Suba's opinion as of August 23rd and what we're seeing. I'm not the rate expert. That's a Barry Habib thing. Watch him. There's a plug for Barry. But we're in a high interest rate environment.
Yeah. Well, high interest rate for our generation, right?
Sure.
Our parents.
Better parents.
Our parents are laughing at the whole 7% percent rate being
Yep.
high,
Yep.
right? Because they in the 80s and late
I think my
70s,
dad
then-
bought at 16% or something
yeah,
like that.
umpteen percent, something ridiculous. I don't know how
No,
they
it's true.
even did that.
I know.
Uh,
Prices were lower.
yeah, prices are lower, right?
Yeah.
Yeah, like you took your GI Bill after World War II.
Yep.
You bought a $30,000
Yep.
property in Levittown, New York,
Yeah.
and you had a ridiculous percentage. Took
And
you
they, and
30
then they
years.
stay there for the next 40 years.
It took you 30 years to pay off a $30,000
Yep.
mortgage. But I think a lot of people want to talk about, like, why would somebody move out of a house, sell a house at a 2-3% rate right now to go into a home that has a 6, 7, 8, whatever we got going on right now.
Yeah.
That's it's hard.
Well, I think this is again my opinion. I think it's an uncertain environment for the ones that aren't necessarily that don't do what we do, right? Why would I leave 2 and 3% to go take my equity and put it into more expensive house and get the same house, and then have a risk of a market crash? Because that's the buzzwords I hear almost every day on the phone. I'm talking to leads or prospective buyers or people that want to upgrade. They're always worried about a market crash. When's it coming? Right? Yeah. When's it going to happen? And that's
some people want it to happen.
Some people want it to happen. Yeah, buy low for sure. But you got, I think, that concern, and they go, why would I do that? But in reality, is that, like, if you look at real estate, this is my take on real estate and all the books that I've read and the education that I've given myself. It's a longer term play. So if I'm gonna move for a year and then move to another house, it probably doesn't make sense to do that.
No.
If I think I'm going to get promoted in the next couple of years, maybe I do sit my 2.25 for the next little bit. Maybe I keep renting, even if that's the case. But, like, if I know I'm not going anywhere anytime soon, like, you've got that 2.25, you probably got lots of equity. Let's talk about other ways to get that equity out. Use it for an investment opportunity, right? Pull that property out. But, like, yeah, I mean, I think a lot of people are just, I think, scared,
right,
or nervous about it.
And you brought up a good point, pulling out the equity to purchase more property. I would categorize that as a possible good chess move, right?
Yeah, for sure.
All right, so but that's not a likely checkers move, right? A checkers move, a bad checkers move is just leaving the equity in the home.
Yeah.
Right? It's earning 0%, it's doing absolutely nothing.
Yeah.
Right. So a good checkers move, in my opinion, is to use the equity in the home to help pay down the amortized loan.
Yeah.
So taking out a home equity line of credit against the of that same property, and using that line of credit to pay down the first trust, and then you pay off that. You make the minimum payment to your first trust. You work like hell to pay down that home equity line of credit, and then you just do it again, and you do it again, and eventually you're left with just the line of credit as your debt
the
instrument.
open line.
The debt instrument for the home, right? If you do it correctly, you can pay off your house a lot quicker in a lot of instances.
For sure.
The problem with it is, like, you can really mess that up too, because now you have.
Well, if you got a spending problem.
Yeah, right. If you have a spending problem.
We talked about that 17 credit card person.
Yeah, that's not for the.
That's not their strategy. They're not. They're the checkers player that needs help with playing checkers.
Yeah, they need help playing checkers, right?
For sure.
Yeah, so, but if they want to if they are in a good financial foothold and they want to be a good checkers play, chess isn't for them. They're
That's
like,
right.
"Oh, this is that's too much,
Too risky. Makes me scared.
Yeah, exactly.
Yep.
Then having a good checkers move would be to pay down that house. Now you have it debt free. Now maybe after the house is paid off, maybe now their risk tolerance goes up a little bit, where they want to take, they use that same line of credit or get a DSCR loan or get a regular investment property with a regular loan, whatever. So maybe because the home base is basically taken care of, that they can branch out a little bit and create a little more cash flow because they're a little more comfortable now. So yeah, like I said, we say it all the time on here. There's no one right way of doing this. It's what you're comfortable with, what your risk tolerance, what you're trying to achieve. But standing around and doing nothing is probably not the best answer. But yeah, having the assets is paramount, in my opinion. Like having them, like just saving, playing checkers first.
Yep.
Like
you got to get started somewhere.
You got to get started, right? Just doing nothing, but also don't swing for the fence thinking you're an awesome checkers player when you haven't even played chess yet. You haven't even gotten over here yet.
Yeah, it's like I'm going to go out and hit a grand slam today, and I didn't take any BP or warm ups or even practice for the past however long. It's not going to happen.
No,
it's just not.
And
or you do it, maybe you get lucky, and you hit one, at some point that success is going to fall from underneath your feet.
Right. Yeah.
You know, you're going to fail
Flash
miserably.
and pan.
Yeah. But there, and one of the books, actually, you recommended the book to me. I think it was the Gary Keller book. It's essentially about the foundations of being a millionaire investor, something to that effect.
Yeah.
And it says in that book, like one bad investment can knock you out of the game forever, right? And so I think if you don't start with checkers to understand some of those basics, like you can't get to the big leagues without the fundamentals.
Right.
You just can't. The big leaguers work on fundamentals every day.
Yep. And it's which fundamentals, right? So, and I feel like that's the biggest difference between the two games, right? Because the checkers players are they're stuck in that checkers mindset that they never get over the chess, because chess has different fundamentals.
For sure.
They're two different games. Like us growing up playing baseball, the fundamentals were the same when we were playing in Little League and we were playing in college. The fundamentals were exactly the same. It was the same game.
Yep.
With finance, though, there are, in my opinion, two different games.
Yeah, that's fair.
It's checkers and chess. Now, how do we build the bridge?
Right.
How do we get over here? How do
I go from playing checkers to chess, essentially?
Yeah.
Cash flow.
Yeah. It's
Play some cash flow games.
the cash flow game. Yeah. It's in the next room over there.
Yeah.
You probably saw it when you walked in. But yeah, I mean, this is great. Just understanding how all this stuff works. Mortgages can be your friend.
Yeah, for sure. I say it all the time. It's a tool.
It's a tool.
It's a tool if you use it right. And not to get into like my personal finances at all, but like when I understood that concept, it was a game changer for me. Like it totally changed my viewpoint. Like I think our parents, and maybe yours told you this, I know mine did, is like you get that 30-year fixed rate and you pay it off, right?
Yeah.
And you work. And I'm not saying there's a place for that. Totally, right?
There's a place for that. I just don't know
But
anybody that's wealthy who's done that.
Right. Like it's a tool if you use it the right way. And when I understood how it can be used and the different things that can be done with mortgage tools is a game changer.
Yeah.
I mean, it just is. Right. And that's part. And that, again, it goes back to like, I'm one of those people, like I actually do like mortgages. I like the internal workings of it, the numbers of them, the math side of it. It just comes easy to me.
Yeah, I hate that part of it.
Yeah, right. And a lot of people do. A lot of people hate the number crunching, and that's what I enjoy. But like at the end of the day, if you understand that, I keep repeating it, the tool aspect of it. It's so important to know that it's not here forever. Like it's there for you to leverage and use it the right way. Like, the wealth isn't built off of paying for cash,
And the banks
paying cash for everything.
The banks want you to do it. They get the interest. The government wants you to do it. That's why you get a tax deduction.
There you go.
Mortgage tax deduction, because they want you to do it.
And the tax book, right? I forget the name of that book, but there was the quadrants, the 4 quadrants. I think that's a Kiyosaki thing too, where you have the employee, you have the small business owner, the big business owner, and the investor. And not everybody can be a big business owner, but basically it's the tax stuff that you have assets to be able to help yourself. The government wants you to do it.
Yeah.
And if you really do read about taxes, the government actually incentivize you. I know that's probably an unpopular belief, but it's true.
Yeah.
They want you to do some of these things and they incentivize you to do it. So yeah.
Sounds good.
Good stuff.
Well, thanks for coming in, man. This has been
Thanks
great.
for having me. Yeah, I hopefully added some value here today.
Of course.
It's fun though.
It's good to see you anyway. But
Yeah,
of
man.
course you did.
Always. It's like we're having a good conversation.
Yeah, man.
Thanks, Freddie.